Hey guys, Lincoln here from boacademy.org. Today, I want to discuss with you a very important concept called opportunity cost and why you need to understand it as an investor. Back in high school, in my second to last year, I took AP Economics. And the only thing that I remember from that class is called opportunity cost. That was the very first time I was introduced to this topic, and it blew my mind away. How could something that you don't choose cost you so much, right? That is the basic question behind opportunity cost. Opportunity cost is the value of an alternative choice that you miss out on when making another choice. So opportunity cost is a very important concept for you as an individual, as an investor, as a business owner to understand, because you're going to have to make many decisions every day about where to put your money. So you can take one opportunity, opportunity A, over another opportunity, opportunity B. And the opportunity cost of taking opportunity A is the value of opportunity B. So opportunity A might give you returns of 8%, but opportunity B might return 20%. But you might have not known that when you made a decision to go with opportunity A. So the value of opportunity B is your cost, is your opportunity cost, right? So let's look at some examples. So let's say you have $1,000 to work with. And you can either choose to save it in your bank account, or you can choose to invest it in the stock market. If you choose to hold that money in your savings account, you might get returns of 0.01% to 2% every year. And the opportunity cost of choosing to hold your money in the savings account is the potential returns that you could get from investing in stocks, right? So the stock market averages anywhere from 8 to 10% every year in returns if you invested in the most basic investment, which is an index fund, right? The S&P 500 could return you anywhere from 8 to 10% on average every year. So your opportunity cost is that 8% versus the 2% that you could get from a savings account. So another example, you could take your $1,000 and invest it in the stock market, which again will return you anywhere from 8 to 10% on average in just an index fund. Or you could take that $1,000 and invest it in real estate, which has historically returned much more if you do it right. So you have the chance of getting maybe 30% returns in real estate, right? Or even 100% returns, or even more. Real estate can get you infinite returns because you can leverage other people's money to invest in it. So you have the choice of investing in stocks, and if you choose that, the opportunity cost is the returns that you could get from investing in real estate. So let's look at another example just in the stock market. There are many companies that you can invest in, right? But not all companies are the same. Some companies will grow faster than others, and some might even pay you dividends. So let's take two companies that I've considered investing in, Upwork and Shopify, right? I chose to invest in Upwork last year, and I didn't invest in Shopify. In the last year, Upwork has appreciated by -4% in stock price. That means that its stock price went down by 4% in the last year. On the other hand, Shopify has gone up by 200%. So my opportunity cost of investing in Upwork has been the 200% that I missed out on by not investing in Shopify, right? It's as simple as that. So one last example just to nail the point home. One of my favorite YouTubers is Stephan. Right out of high school, he went into being a real estate agent and then started investing in real estate. So instead of going to college, he spent those 4 years building up his career as a real estate agent and investing in real estate to start building his wealth. And in that 4 years, I was in college, not earning any money, right? Just learning. So the opportunity cost of me going to college was the 4 years that I could have spent building up wealth, just like Stephan. He spent 4 years investing in real estate, so now he has a net worth of over millions of dollars. But I went to college and I graduated with a 6-figure job and a computer science degree on my resume. So Stephan's opportunity cost of not going to college was that he didn't get that degree on his resume, right? He didn't go to school and learn whatever there is to learn in whatever field he might be interested in, which might have been valuable to him in his career. But of course, he didn't make that choice, and he chose to go straight into real estate and becoming a real estate investor and building up his wealth. And I don't think he's going to need a resume anytime soon, right? And definitely not a college degree on that resume. He's done pretty well for himself. So his opportunity cost wasn't that big of a deal for him, because it turns out that the choice that he made was the best one for him, right? So sometimes your opportunity cost is going to be very heavy, but in some cases it won't be. So that's what an opportunity cost is, right? It's the value of the alternative choice that you miss out on by choosing something else. That's all it is. So you have to keep that in mind when you're investing in companies, in real estate, in any asset, right? What is my opportunity cost of choosing this company to invest in versus this company? Is this company going to grow more than this company, right? And after the fact, once you see that your company grew more or grew less than that other company that you didn't choose, then you know what your opportunity cost actually turned out to be. But you don't always know it when you're making the choice. So it's important to understand what you're investing in and what the potential returns are, right? You have to know that if you're putting your money in a savings account, your returns are pretty much limited to 0.01% to 2%, right? And if you're investing in the stock market, your returns can be averaged at 8% to 10% in an index fund. But if you choose your own companies to invest in, then you have a potential of getting even higher returns. But of course, that comes with more risk. So the opportunity cost of you choosing to invest in index funds over choosing your own company is that you're missing out on potentially higher returns on your investment. So thank you for watching this video, and remember to always practice the bull mentality. The bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term. That is how you build wealth in this country, and that is how you give yourself the best chances of success investing in the stock market. So thank you again. If you enjoyed this video, please remember to like the video down below, subscribe to this channel, hit the notification bell so that you know the moment we publish a new video, and comment below what you've learned and what you would like to learn in the future. And thank you again, and have a great day.